Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in corporate filings. And tonight we're diving into Caterpillar's latest report to see if this heavy machinery giant is still building a solid future or if some cracks are starting to show. We're looking at a brand new set of credit agreements that Caterpillar and its subsidiaries have put in place. Think of these as borrowing arrangements that help the company manage its cash and fund its operations. It sounds a bit dry, but trust me, there are some interesting details here that tell us a lot about how Caterpillar plans to keep its massive engine running. So what exactly did Caterpillar announce? Well, they've updated their borrowing power with new credit facilities. These are essentially lines of credit that the company can tap into if it needs cash. It's like having a very large credit card for business needs, but with much more complex terms. They've entered into what they call a 364-day facility. This is a short-term credit line, meaning it's designed to be used for a year or less. It's for a substantial amount, up to $3.5 billion. This facility is unsecured, which means Caterpillar isn't putting up specific assets as collateral. This usually tells us the company is considered low risk by the lenders. They've also set up ways for their international subsidiaries to borrow in local currencies like pounds sterling, euros, and Japanese yen up to a certain amount. This is important because it helps Caterpillar manage currency fluctuations when doing business overseas. But that's not all. They've also updated their longer-term credit agreements. They've essentially redone their 3-year and 5-year credit facilities. The 3-year facility has been extended and now allows them to borrow up to $3 billion. And the 5-year facility, which is a longer commitment, gives them access to up to $5 billion. These are also unsecured revolving credit facilities, meaning the money can be borrowed and repaid multiple times over the life of the agreement. Again, the fact that they are unsecured is a strong vote of confidence from the banks. Now, these agreements aren't just a blank check. They come with strict rules called covenants. Caterpillar has to maintain a minimum consolidated net worth of $9 billion. That means the total value of what the company owns minus what it owes has to stay above this number. This is a key indicator of financial health. For Caterpillar's financial arm, Cat Financial, there are also specific rules. They need to maintain an interest coverage ratio above 1.15 to 1. What does that mean in simple terms? It means Cat Financial needs to make enough profit to easily cover its interest payments. If that ratio drops too low, it signals trouble in paying its debts. They also need to keep their leverage ratio, which is basically how much debt they have compared to. There are also specific rules they need to maintain an interest coverage ratio above 1.52 to their net worth of $9 billion. Simple terms, it means Cat Financial needs to make enough profit to easily cover its interest payments. If that ratio drops too low, it signals trouble in paying its debts. They also need to keep their leverage ratio, which is basically how much debt they have compared to their net worth, at 10 to 1 or lower. It's also worth noting that as of the date of this filing, Caterpillar hadn't actually borrowed any money under these new or extended facilities. This tells us they are likely in a strong cash position currently, and these are more for securing future flexibility and potentially lower borrowing costs. And here's a small but important detail. The banks that are providing these loans are the same ones that Caterpillar has worked with for other financial services. This is pretty standard. Big companies use big banks for many things, and these banks get paid fees for all their services. It just shows the deep financial relationships that exist between Caterpillar and the banking world. Looking deeper into the 364-day deal, it replaces a similar agreement from the previous year. This is a common practice for large companies to constantly update their credit lines to ensure they have the best terms available. The fact that the new deal is for the same amount of money and probably has similar or better terms suggests stability in their short-term borrowing arrangements. And when it comes to the amended and restated agreements, the fact that they extended the 3-year facility to August 28, 2028, and the 5-year facility to August 28, 2030 shows foresight. Caterpillar is planning for the medium to long term, ensuring access to funds even further into the future. This isn't just about getting money now, it's about securing their financial runway for years to come, which is crucial for a company that makes massive investments in factories and equipment. Now let's consider the overall picture. Caterpillar operates in a cyclical industry. When the global economy is booming and construction and mining are strong, Caterpillar thrives. When there's a downturn, they feel it. Having these robust credit facilities, especially unsecured ones, in place suggests that Caterpillar is seen as a low-risk borrower by the financial markets. This is a testament to their strong brand, their operational efficiency, and their proven ability to weather economic ups and downs. The fact that they haven't drawn on these facilities is also a positive sign. It implies they're generating enough cash from their core business to fund their needs. However, having these credit lines available is like having insurance. You hope you don't need it, but it's incredibly valuable if you do. For Caterpillar, with its global operations and significant capital expenditures, this financial flexibility is paramount to its long-term success and strategic growth. Securing these lines of credit is a proactive move that allows them to pursue opportunities without being constrained by immediate cash availability. It also projects an image of financial strength to investors and the market. So to sum it up, Caterpillar has essentially renewed its financial ammunition. They've secured multiple credit lines, both short-term and long-term, totaling billions of dollars. These are all unsecured, indicating a strong credit standing. The covenants they've agreed to, like maintaining a certain net worth and specific ratios for their financial arm, are standard but important checks and balances that show the company is committed to financial discipline. The extensions on the agreements show a clear focus on long-term financial planning. While they haven't used this new borrowing power yet, its availability provides a significant safety net and strategic advantage for future investments and operational needs. It's a strong signal that despite any potential economic headwinds, Caterpillar is positioning itself to continue its operations and growth effectively. What's my take on this? Caterpillar is playing it smart. They're proactively managing their financial resources and ensuring they have the backing of the banking sector for years to come. This is crucial for a capital-intensive business like theirs. The strong terms of these agreements, particularly being unsecured, reflect the market's confidence in Caterpillar's financial stability and future prospects. The key risk for Caterpillar always lies in global economic cycles, but with these financial tools in hand, they appear well equipped to navigate those potential downturns and capitalize on upswings. It's a sign of a well-managed company that understands the importance of robust financial planning. Alright, that's our breakdown of Caterpillar's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.